At this point, no. I mean, the markets are basically 95% priced. We're effectively there. There's nothing the Fed needs to say. And in fact, there haven't been that many shocks. So I think, in the statement themselves, it's sort of, all ready to go forward. They tweak a little thing, show that the economy is on track, do nothing, and that seems to be what we're set up for tonight.
It's all about that language and the statement, isn't it? The sort of wording about whether we are getting closer to the end of the road and getting towards that neutral level. What do you think? Do you think the Fed thinks we're there, and what do you think?
I don't think the Fed thinks we're there. I think there is a wide universe in terms of where that opinion is within the Fed, and this is where everyone tries to tease the dots and see where everything is. And I think it's clear that most of the Fed thinks that neutral rate is somewhere around 3%, but we've also seen that as they keep hiking, the big conundrum has always been, well, we're hiking, but we're not getting as much inflation, we're not getting as much wage growth as we thought, therefore that neutral rate must be higher. And it's really learning about these things ex post. So I think you're still drifting up, I think we're there, but I think what's more interesting even than are we at neutral, the market seems to have this impression that when you get to neutral you stop. But in fact, if you go through those dots and try and tease out where the voters are and the participants are with the Fed, almost every one of them assumes some sort of overshoot to that neutral rate. So it does matter, but most of them see the economy growing even stronger than it should, and they think they're going to have to hike past that.
This is the problem. What's in front of the central bank versus what is down the track? And what's in front of them right now has been a growth rate of more than 4%. Yet it's very hard to find a lot of market participants who believe that is a sustainable level. So what's in front of the Fed now could be very different to 6 months' time. What do you make of the growth story and how confident the Fed could be at this point?
And that's what's in there, right? I mean, if you think of the fundamentals that are sitting there, we are at a labor market. I think on Friday, you're likely to see the unemployment fall from 4 to 3.9%. So we're going to be running at a very low unemployment rate that has been putting upward pressure on wages so far, continues to do that. So an underlying core, and they look at the Fed and say, look, a number of participants at the last Fed meeting in the minutes suggested they saw upside risk to inflation from that. But I think you're right. That 4.1 that we had for GDP for the second quarter, when you look through those details, 4% of it was consumer spending. So outside of that, nothing happened. That's sort of the negative way to look at that. That, when all this focus on trade wars and protectionism, when you go through the business and imports and exports and inventories, it was effectively zero growth. So I think the Fed looks at that. I think they see it as a risk, but you don't step in front and you don't change policy from the base case of what's going on and the assumptions there for a risk that's going on. I think that's the problem the Fed has. There are some that are worried. It's just not something you can do much about yet.
The inflation mystery that's been around for central banks to try and deal with also seems to be disappearing, because if the trade war kicks into full gear, and we've now of course had the threat of a 25% tariff on $200 billion worth of Chinese goods, not 10%. I mean, that was bad enough for many economists. This would be a full trade war with effects going right through to the consumer level, driving up prices. This would have a fundamental change for inflation, surely, and that would cause the central bank to perhaps have to act.
It's very much a stagflationary shock, and I think the Fed sees it that way, and they know that that's an issue. And I think in some ways it's almost similar to some of the debates the Bank of England has had to have around Brexit. And I think the questioning that the Fed will have, well, it may be inflationary and it may lower growth, but is that a lower growth because of a lower potential and a lower amount of supply, in which case the Fed still has to continue tighten. They don't want to lose that anchor to inflation. And so we may be sitting there and saying protectionism is bad, it's going to be stagflationary, but that doesn't necessarily mean that the Fed is not going to hike. They may actually need to anchor things further, and it really depends how that feeds through.
Do you want to give us a quick line on the best trade around the central banks this week? Because there's been a lot of action.
Yeah, I mean, I think so far, we're still looking at 530s flatteners in the US. So I think over on the curve, you had the BOJ come through, that's there, and it's a mild dollar buying bias in FX.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.